I want to talk about a small problem I have with a new trading system of mine. New trading systems are not in and of themselves a problem because they come with a certain set of expectations. This new system I have is about 6 weeks old, and it was designed specifically to trade IG Market's collection of US CFDs. This is a fairly broad universe, and as a matter of coincidence, most of the stocks I've ended up trading seem to also fall within the NASDAQ index itself. The problem I have with this system, and the problem that has arisen, is an interesting one because it's an emotional problem. It's not a technical problem to do with the system. System-based problems are very easy to deal with. They're quite simple. They're very mechanistic. They're simply a matter of pulling the system apart and seeing what's going wrong. Something might be wrong with the mechanical aspects of the system, and they're easy to fix. This particular problem is different, and it forms the basis for this little chat. This system's been running now for some 6 weeks. At present, it's sitting on a 21% profit when marked to open equity. Now, that's the incorrect way of valuing a portfolio because effectively you're valuing the market's money. And coincidentally, I'm currently examining a new portfolio manager, and it makes precisely this mistake. It measures the market's money, not yours. So we tend to mark to the value of our stops, and even mark to the value of the stops. This system is up 11%. This is unusual, and it is unusual because my experience has always been that most systems begin with a drawdown. This one has fluked a different beginning, and I will say fluked because through an odd confluence of events and stock solution, it seems to have, for the time being, skipped that little part of system evolution. It's worth noting that during the same period, the market was only up 3.4% itself. It is quite possible, therefore, that I could take my system, give it to one of the shonks in the market, and he could quite rightly market it saying it was generating 156% per annum annualised return. But that's not the point of the conversation. I've spoken at length about how unreliable performance figures are, how they can be fudged, how they can be manipulated, how it can appear that you're actually making money, but in reality you're not. What I want to look at is how you might deal with a situation where a portfolio does this, where it simply takes off, and it takes off in an unexpected manner. The thing to note is this is not normal. And one of the difficulties I see that traders run into is they form an expectation that this sort of behaviour is normal. They might get an outlier period where this occurs and presume that that is the natural course of events. It's not. I fully understand that this is an outlier in performance and is not the performance I expected at this stage of the system's development. We're all familiar with the notion of loss aversion. This is the fact that if we lose $100, it has a greater emotional impact upon us than if we make $100. We struggle with this notion of losing money. Losing money is problematic to us. It causes us pain. Examples of this abound, and this is my favourite. This is Babcock & Brown from the GFC. Babcock & Brown have ceased to exist. They're no longer listed. You can see that the market gave all the participants in Babcock & Brown infinite opportunity to get out. You were given opportunity after opportunity, and you can see volume plotted along the bottom of this chart. You can see that there was always a number of willing buyers, even when the stock had lost 99% and was down at 32.5 cents. there were still people buying the stock. In part, many of those would be people who already own the stock and who were averaging down. They simply could not bear the pain of suffering a loss. And there's a variety of reasons for this, most of them locked up within the fragility of our own ego. So this is one side of the equation. And I want to mention this because it does form one side of the emotional equation that traders face. But at present, this system is presenting the opposite problem. And the opposite problem is that gains can be destabilising for traders. Very large gains are very destabilising. If we were to look for an archetype of this, if we were to look for the poster child of how a sudden change in fortune can alter people and disturb their life, you probably need look no further than people who've won lotteries. Their lives are enormously destabilised by the gain they've just received. The same thing happens with traders. Portfolios that accelerate very, very quickly tend to destabilise traders. They tend to cause us to do odd things. Our behaviour begins to change. As an extension of this, large gains that are lost are emotionally devastating. So if you've had a situation whereby a position has gone up dramatically and that position has come back and leaves you with a loss, the effect of that on the trader is extremely devastating. That's very, very painful. With those things in mind, the prime behaviour of traders is to try and grab what they can and run. And we undertake all sorts of interesting self-talk to justify this. There are all sorts of homilies in the market, such as you can't go broke taking a profit, or you should leave something on the table for somebody else, as if trading were some form of Christian charity that required you to leave something for somebody else. I want to look at how I deal with this problem within the context of one of the trades this system has generated at present. This is Trina Solar. I have no idea what they do. I'm assuming, given their name, that they're involved in solar power somehow. What I've done here is marked my entry. My entry was at 9.50. When I trade US stocks, I don't actually sit up all night watching them. I put in place contingent orders. I want price to have moved beyond a certain high and the order is triggered automatically. Interestingly, I've never had any problems with this as a strategy. Some people insist that you have to sit up and watch markets all night. With a weekly system, you don't. Because entry is the least important part of the trading process. I know that the vast majority of the trading community disagree with that. But it's quite possible to take random entries and very good money management and make money. People actually bring very little to their trading system beyond what the system has. The profitability is in the money management. It is in not doing your dough and living to fight another day. You'll also notice with this signal, it's nowhere near the bottom. This system does not look for lows in that respect. It doesn't try and see where the bottom of a move is and hit that. My ego is not invested in the price with which I buy something. I will never get the low and I will never get out at the high. I'm not concerned about that. To me, they're false gods that very naive traders attempt to follow. So I have this position that's in at 9.50, and you can see that in the subsequent 5 trading periods, and this is a weekly system, so that's 5 weeks, price has run away strongly. The stock is now sitting just above $16. This raises the question of how do you manage this? Because in the portfolio at present, I have 2 or 3 stocks that are performing like this. For me, the management is quite simple. You pick a stop loss that is sensible and logical. My attempt with my placement of stops is for them simply to be cognizant of and reflective of what the market is doing. There is no perfect stop. There will be stops that get you out early, stops that get you out late, and occasionally one will get you out just right and you'll be happy. But the issue for me is that you can see with my stop placement at 12.50, I'm still a long way away from price. I don't chase price because I want price to unfold. There is a belief in trading that if you run your stops very, very tight, you minimize your losses. In one interpretation, that's true. However, what you do is encounter a vast number of very small losses, which you might interpret as being a good thing. The problem is you miss out on the very, very, very large gains. From my perspective, I'm able to run a stop that is fairly deep for this sort of system simply because I'm not emotionally invested in the position. To me, it is simply a widget. So if it gets knocked out overnight, I don't notice until I look at the reconciliation in the morning, and then I move on. I move on because I learned a very, very long time ago that you can't have your ego invested in the decision. You have to be completely devoid of ego in trading. You can't become emotionally involved in positions. And I keep this quote in my office to remind me that I actually know nothing about where the market will go. And since I don't know where the market will go, I have no real stake emotionally in the outcome. This is a quote by Irving Fisher, a noted economist of the early part of the last century. He said that stock prices have reached what looks like a permanently high plateau. He said that 3 days before the beginning of the October 29 crash. And interestingly, because he was emotionally invested in his opinion, he continued to cling to this opinion throughout the crash. And the rest is history. It is important to realise that even if you miss out on a trade, and this is something that took me a long while to recognise, that at a guess, the average turnover of all financial markets in an evening is around about $5 trillion. So that even if this trade fails, even if it comes back and hits me at 12.50 and I get out with a modest profit, there will be another one, because my view is quite simple. Trades are like the old tram I used to get home from school. One will turn up every 7 minutes during the week, and at the weekend they might be 30 minutes apart. But there will always be another one.